Hey, it's Soleil, and this is episode 174 of the Orange Pill Investor. And today, of course, I'm going to be rolling. Friday is roll day, but got a metric ass ton of new followers uh, from this tweet. And my follower account went up like 25% when I went to sleep, and then I woke up and it was up 50%. So hat tip to Jeff for tagging me in a post that went absolutely nuts. And so a lot of times I try to speed run through these, through rolling these contracts. But since we got a bunch of new people, I'll try to slow it down a little bit. And I feel like there's a little bit of added pressure to really lay it on thick and put out some quality. But as you can see, I'm not wearing a suit and tie. It's still going to be t-shirts only. But let's get to it. Expirations are every Friday. Some people sell longer than 1 week expirations, and I have a few on here that I did go out to 45 days because I went on vacation for a week. And selling covered calls is basically easy mode. If you don't want to work the following Friday, you just go out 2 weeks or 45 days. Then you go on vacation, you just don't worry about it. You make money while you sleep. Um, the point isn't necessarily to maximize upside. The best way to do that might just be to hodl, or if you have supreme confidence, even buying some long calls. But in general, those are pretty risky. So I try not to make those more than about 10% of total portfolio. But let's just get started. So here's the main account, and I've got two covered calls expiring today. Sold them for 1,200 each. Have to buy them back for about $3 a piece. So let's just try to close those out. I'm just going to speed this up a little bit. You want to go as close to the mid price as possible so that you don't overpay for these. But sometimes for the purposes of time, I got a plane to catch, and nobody likes watching dead space on a video. So pocketed about $1,000 each for those two. And I was considering doing a strategy because I'm expecting with this 10-to-1 the market to just be irrational and start buying into this because they want the split, even though cutting a pizza into 8 slices versus 16 slices doesn't change the size of the pizza. But the market's irrational, so I'm kind of expecting this to pump. But I actually layered in a little bit too much upside insurance here. I said I like to keep about 10%, max in like long calls. And I'm thinking this is probably closer to 20%. So to actually not bother me too much if this pumps and breaches my strikes next week. But I do try to collect about 20% upside. So that would be, if I just round this to 1,400, that would be 280. If I add $280 to the current price, actually it's gonna be 270. 270 plus 1350 is 15, 16, 20. So if I look and see how much premium I can get paid at the 1620, it is not 1%. I usually try to collect at least 1%. That way, if I wanted to, I could buy an additional share every week. So I'm just gonna slide this up and see what kind of upside I can get collecting approximately 1% for the week. So the mid price on this option, selling this covered call would be about 1340. So that's just about perfect. I could just go to the 1500 strike where there might be more liquidity. So the distance from 1350 to 1500 is only 10% ish. A little bit more than 10%. So I don't love that. So let's go up to the 1510. That just squeezes a little bit extra. Not quite getting 1%. But let's try to sell that for, and let's do 2 of them. Actually, that is 1% if this fills. No. Oh, they filled. Okay. That'll work. Trade price was 1378. So I got a little bit more than 1% yield for each of these contracts. I will be able to capture upside from 1350 up to 1510. Now, if this rips to 1800 like it did to me a few months ago, I would be on the hook for quite a pretty penny. But I do have these long calls that will appreciate just about as fast as that. And so if I want to protect myself against a run up past my 1500 strikes to like 1800, for example, that means the distance between 1500 and 1800 would be about $300 a share, which means if I don't want to lose these 200 shares, I would have to pay 30 grand. The price is 1800 a share. Whoops. I got to come up with 30 grand and the price is 1800 a share. Take 30 divided by 1800. That means I would need to carry about 16 shares or 16 delta in order to insure each of my covered call contracts. So I need about 32 delta, and I've got 80 right here. I've got 30 here, and I've got another 16 here. So these are more than insured. So that should not be too much of a worry. Now, this contract, this is a credit spread, a put credit spread, and I try to keep these like 1 to 2% max. I barely even cover it in the videos. And, and the only thing that I really want to say about them right now is even though some folks will say these are defined risk trades, which they are supposed to be, because the option that you purchase is supposed to insure the option that you sold. However, and maybe I'll do a full video on this. I think I've covered it before, but you can get screwed and and basically get wrecked if the person exercises their option and then your exchange automatically exercises your option to protect you from the other person's exercise, and then that person decides before it executes, cancels it. Your exchange does not uncancel yours, and now you're on the hook for a bunch of monies. And then if the price of that stock goes against you, you can have, basically infinite risk, even in a defined risk trade. So a lot of times, since this is kind of a loser, I mean, I need MicroStrategy to go back up above 1400 for me to win this. But if it doesn't by, I would say Wednesday or Thursday, if this is kind of close, I will just close this position because the risk is just not worth some weird freak accident situation. All right, here's the covered calls that I just sold. Here is another credit spread that I added as the price of MicroStrategy went down. I really need my glasses. Okay, so 35 days left on these. It's another put credit spread. So that one can just hang out for a bit more. And then these are the, I want to call them leaps, but they're no longer, they're not over a year old. So most people wouldn't even say they qualify as leaps. We'll just call them mid-range long calls or whatever. I may come back to these. I may want to dollar cost average into these a little bit, or even sell some and consolidate. Because what I'm really looking forward to after this 10-to-1 split are these, if I'm expecting MicroStrategy to pump maybe through October-ish, then I may want these December 2025 calls, which instead of being $22,000 will only be $2,200. So that will be nice, and it will be much easier to dollar cost average into these if MicroStrategy takes a dump. But I'll just bookmark those for now, and if I forget, it really doesn't matter. These can just hang out. That's fine. My working orders. All right, Riot. I save. I trade every Friday with my son. He's a broke college kid, but I got him set up with some money from his part-time job, and so he's got 100 shares of Riot, and we sell covered calls against this every week. All right, Tesla. Tesla was on a tear, and similar to these long calls that I was buying as upside protection, I was doing the same in Tesla, and so made a good bit of money here. Bought, I think I had 6, 7, 8 of these maybe. Paid average trade price was about 1,100, and I sold some for 2, 3 grand a pop, and I only have 2 left. And so I think I'm just gonna hold on to these like right before, might sell these next week, like right before earnings. Not necessarily because I'm expecting Tesla to go up or down. I generally do not make any directional bets, but because implied volatility collapses after earnings. So right now, Tesla's IV rank is 106. Anything over 50 is fairly high and could indicate that selling options could be profitable. And then I would expect this to, this IV rank to probably collapse in half after after earnings, unless the price does something crazy. If the price drops to like 150 or goes up to 350, implied volatility is going to be pumped along with that. But I definitely, so I basically sell covered calls against just about everything, and the reason is to reduce my cost basis. If I get 1% premium every week for 52 weeks, my stock is free. It costs me nothing. And if I take that 1% premium every week and I buy 1 share of that stock, then 52 weeks later, I've got 52 shares of that stock. Um, and you do that for 2 years straight, you got an extra 100 shares, and now you can sell 2 covered calls. So that's the strategy. It's not necessarily meant to maximize upside. Buy and hodl may work out better a lot of the time. However, taking small wins every week fits more into my play style. So let's take a look at the 270 strikes that I sold last week. I will be able to close these for pretty close to all profit. Let's sell, yep, all 4 of them. So I got to buy them back for $4 a pop. Now I can take the 100 shares when I have 4 increments of 100 shares, and I can sell covered calls for next week. 7 days to expiration. Short call option go. The premium is not as lucrative for Tesla as it is for MicroStrategy, but let's see how much I will be able to get if I try to bake 10% call away value in. So that would be 10% of 245 is 24 bucks. If I add 24 to 245, I get like 270. So how much premium can I get at 270? Not 1%. So it looks like I need to back this up to about the 265 strikes. So $20 in call away value, not terrible, but let's do 4 of these. Filled. Thank you very much. So booked about 2,400 in premium for MicroStrategy, and where are they? There we go. 4 of these, 250 bucks a pop. That's another grand. So earned about 3,500 in premium on this account, which is about 1% for the week. So that's nice. And then, oh shoot, I skipped over Hut. All right, this one. Oh, I think this is one that I'm basically copy trading with a follower. So I will probably deal with this one offline, but you can see that I sold a put at the 15 strike and the price has now dropped under 15. So I will probably just let this get assigned, which this is the first half of the wheel strategy. If anybody's heard of that one, you sell a put and you collect, I collected $71. And then if the price goes below my strike price by expiration, it'll be assigned, which means it's basically the reverse of a call. And instead of my shares getting called away, this person is going to force me to buy their shares at $15 a share. And then I'll be the proud owner of another 100 shares of Hut, which I can then use to sell covered calls against. And in this case, it benefits him because now he forced me to sell them at 15, but really the price is 14.80. So he'll make out $15 a share. Excuse me. Sorry, 15 cents a share. But it works out for me because I got paid $71, so that reduces my cost basis from the 15 down to 14.25. It's basically like, do you think you could do well in the stock market if you get a discount every time you buy stock? That's what selling puts means to me. This one is 15 days out. This is another one that I'm copy trading with another X account. And we actually went out 45 days on this one. And you can see Hut has well breached this strike. So we will just sit on our hands and we will wait for expiration. And our shares will probably get called away at 11.50. And those 100 shares cost us around 10.30 a piece, which means that when we sell them for 11.50, we'll make about 120 bucks, $1.20 per share, times 100 shares. So that's a 10% profit in just, a couple of months, and then plus all of the premium that we've collected here. So I will deal with those later, but that's how you roll with that one. Okay. That is the main account. Now for the IRA. I have one covered call that I sold 45 days to expiration. And now it is down to 21 days left. So I should probably either, If I want to get this back down to 1 week, I can just sit on this for another couple of weeks until it's 0 days to expiration, or I could continue to just demonstrate how you would use the 45 days to expiration. Let's see what happens if I roll this. If I roll my expirations out to 42 days, and if I try to get one, well, see, it's a little bit different because this is basically a poor man's covered call. So I've got this in the money leaps. It's not even a leaps anymore because it's only 6 months away. But its value is about 47,000. So if I try to collect at least 1% of that, let's just round it to 500 bucks a week, and I'm going to manage this every 2 weeks, then that means I need to collect 1,000, and you generally try to collect about half of what you sold it for. So that means I would need to, I want 500 and I want to do 2 weeks, I got to double it to 1,000. And if I'm only going to collect 50% of the original price, that means I need to double it again and get 2,000. So let's see how much call away value I can squeeze into this for 45 days, close to 45 days, at the 2,000. Oops, went too far. So right about here, the 2,100 strike. So I can build, good Lord, $750 worth of call away value in here and still collect. What is that? Let's see, 1,300 or 135 would be 10%, like 5. Like 50%. 50% call away value. That's pretty ridiculous. So let's actually be a little bit greedier than that. Let's nice round number here. Let's do this one at the 2,000 strike. But I'm rolling for a debit, which is not what I'm interested in doing. So I would have to, in order to break even on this, I would have to go all the way up to the 1,700 to have a little bit of a credit here. Not sure if that's worth it. Decisions. Here's the other weird thing too. This is going to split as well. So I'm going to end up with 10 long calls here and 10 covered calls. And I've actually got more premium available here than when I sold it because the price has gone up. In that case, I may just sit tight on this. Yeah, probably just going to have to sit on that one. All right, so moving on to Riot. I've got 1,100 shares that I can sell covered calls against. And let's roll to next week. In the mining stocks, I really don't care if they get called away. So sometimes I'm way greedier on collecting premium. But let's just go ahead and do the standard. I'll get about 1.5% at the 1050. And let's see if I can get this to fill at 13. I doubt it. Okay, it doesn't fill right away, within 5 seconds, I'll just drop it. And again, 5, 4, 3, 2, 1. I don't get a fill. Drop it to 11. This should go through. There we go. So, made $100 selling those. And what I'll generally do with this money is buy some more shares. So I can get 15 shares. No, sorry, 12 shares. Nope. 11. There we go. And that's the point. So just constantly using the premiums to add a longer position here. So with with Riot, my trade price on those shares is 965. If they're called away at 1050, I will profit all the way from 965 to 1050. So not quite $1 per share, but of course I'm chipping away and collecting a little bit of premium here. So my true cost basis is actually lower than this. And then of course I have the 51 extra shares that have unlimited upside. So if Riot goes to 20 by next week, I'll get the full upside on these 51 shares. All right. This is the joint account. I'll probably split the main account up half and half here, as I'm expecting the MicroStrategy and Bitcoin to pump over the next year and a half. I think these exchange accounts are only insured up to a certain amount, and so if I start getting too close to that, I don't want to have any uninsured money in this account. But I accidentally actually sold this credit spread. I meant to sell it in the other account, but no big deal. In this account, I added some CLSK. I dumped Mara because they started mining shit coins, and I just don't do business with any company that's not Bitcoin only. So let's see what I did. I sold the 15 strike puts and collected $49 per contract. And I should be able to, actually, I can just roll these. So, I mean, it doesn't really matter if you do this two-step process of closing these out. Returns my buying power back to the account, or whether I want to, I could have done the roll to this expiration in one step. But I'm just going to make sure that I short put here. And actually, I can even be a little bit greedier because if I roll to the, if I sell the 15 strikes, I would get a bigger discount if CLSK hits the bed. But I can actually collect about 50 something dollars for next week. And the capital required is the cost of the strike. So that would be 1550, which is like 3.5% return on capital for the week. So that seems like a good deal. Let's sell 20 of those. You can see, if you noticed here, it's actually only taking 13 grand of buying power away. That's because it's a margin account. Be extremely cautious with margin. If CLSK drops in half, I could end up getting a margin call. Bad things happen when you get margin calls. So, but in any case, even if it was obligating the full 30 grand, I just put 20 times 50, $1,000. Just collected $1,000 in premium with that 30 grand. So that's it for these accounts. And I'll go over to the 5K account. Decided to do a challenge where I can run the same strategies, but on all cheaper stocks. So even if you can't afford MicroStrategy, MicroStrategy is going to be a hell of a lot more affordable very soon, but it's still at $100 a share. What is it? $130 a share. It's still pretty pricey, but you can get yield on stocks of any price. It doesn't really matter how big or small your account is. I look at it as the account value itself is X, and I'm earning 1%, 2%, 3%, whatever it is per week off X, whatever X is. So if X is a 5K account, I'm getting 1% off of that, so I'm getting $50 a week. If you've got a 100K account, I'm getting 1% of that, so $1,000 a week. Now the X can go up or down wildly. So if like I've got 500 shares of Riot here. If Riot collapses in price by half, the value of X is going to drop dramatically. But that's the same problem that everybody has who owns shares of stock. So you don't want to lose money, or you're afraid to lose money, can't lose money, then the stock market's not where you want to be. I guess you can hide it under your mattress and just wait for it to get debased slowly from inflation. But same process here, and this is Robinhood. I got the 5K account in Robinhood. A lot of people get their start trading options in Robinhood. I know some folks will never forgive them for halting GameStop back in the day, but I was pretty pissed about it myself. But that's why I moved most of my money over to Tasty Trade. I learned a lot from their videos. And so basically I sold a 15 strike put, basically just like the other account last week. And now I have to buy it back. I just paid $4 to close it. That buying power is now back into my account again. And now I can sell a new put for next week. Let's do the same thing we did on the other account. I'm going to sell the 1550. Just try to get the default mid price. Cha-ching. When I'm selling puts, I generally just sell at the money for 1 week. It's completely reasonable to sell, 1450 and just collect a little over 1% here. And then if the price does fall to 14, you get a bigger discount on your purchase price. It's completely valid. Tasty Trade's method is also valid. You can go to 45 days. 45 days is on Tuesday if you want to open your contracts on Tuesday. But here, you could go down to around the 80% chance of profit, whatever. Let me right here, the $12 strike. You'd manage this again every 2 weeks. So you'd be looking to book half of this profit. So maybe $29, which over 2 weeks would be about $14.50 a week. So pretty similar returns to selling weekly. But, well, not as greedy as I get with the premiums when I sell weekly puts. I'm getting like 3.5% here for the week. All right, let's see what else we got expiring today. I got 3. So I got 5 covered calls in Riot. 3 of them I sold at the 10 strike. Got paid $15 each. So I will close all 3 of these, pay $2. And that's the other thing too. There's a little bit of friction in these deals. Every time you enter a contract and exit a contract, it's almost like paying the VIG at a poker table at the casino, because the bid-ask spread is going to be at least, 1, 2, 3 cents apart. All right, so I closed those 2. I should have 2 more. these actually got breached. So I got paid 26 and they're worth 18 now. So I'm only going to be able to pocket like $5 on each of these. Completely fine. This one I got paid more on each contract, but I did not get the full appreciation and the upside. All right, might have to replace this and pay an extra buck. Yeah, that's fine. All right. If I put the asking price, these should immediately fill. There we go. All right, so now that frees up 500 shares of Riot, and I can sell covered calls for next week. If I build 10% call away in here, that'll get me to almost the 1050. So let's do, I'm just going to do 5. All 5 on the same strike. It's completely flexible. I mean, you could sell one here, one here, one here, whatever ratio you want to do. Or some people don't even sell covered calls on every share. I generally do, but completely not. You know, there's no law that says you have to do that. So Riot's good to go. CLSK is good to go. Hut was already good to go from when I went on vacation. So I had already rolled this out to 8-2. And it's the 15 strike. So this one is also threatened. I sold it for 77 and I'd have to buy it back for 140. So I'm just going to sit and do nothing here. The way that, well, let's go through the exercise. So when a call is in the money, this is one of the hardest concepts for me to get through my head. Like, why did they have to call it in the money and out of the money? Why can't you just say it's above the number or below the number? And the only way that I could kind of remember this is it's in the money when the buyer could exercise it for a profit. That's when he's in the money. So I kind of have to look at this from his perspective. So he could call away my shares and I'd have to sell him my shares at $15 a pop. So the intrinsic value and profit for him is the difference between the current price, which is 15.17, and this strike price. So he would book a profit of 17 cents per share. That's my fantasy football draft group text just going absolutely fucking bazoomny right now. So you can just tell my absolute dedication that I'm recording this video instead of being a degenerate staring at the draft. But well, and the price is fluctuating. But when this was 15.17, he could book 17 cents a share profit if he exercised that call. So this is technically in the money. But the way that you figure out how much value is left for me to collect to between now and expiration date, I have to take the value of the option, subtract the intrinsic value, and anything left over is extrinsic value. And so this is already jumped to 1505. So there's only 5 cents of intrinsic value in this damn thing. So if I subtract that from 131 before the friggin' price changes again, it's going to be 126 of extrinsic value. That's how much I can collect if I just sit and do nothing until 8-2. And that's pretty decent compared to the price of the stock. That's like 10% over just 3 weeks. So 3% a week. So I'm going to do nothing with this. Some new traders, anytime the strike price goes above their call, they're like, oh shit, I sold it for 70 and now it's 140, 130. Oh, should I roll it? And then they're going over here and they're trying to find, it's called rolling out and up. So if I wanted to roll this out to, 45 days again, so I could make this not be a debit, it was worth a 130. So I could roll out to the 16 strike or the 1650, collect a tiny premium, and then I would give myself a little more breathing room here. But to me, that's just kicking the can down the road. Since I did this calculation and I see that there's a good amount of extrinsic value left that will flow to me in the form of theta every single day. Let's just go down. Quick Greek lesson. Theta is the amount that this option contract will decay every day. So it's going to lose 3 cents of value every day. So every day that I hold on to this contract, the value becomes less and less, which means it's cheaper for me to buy back later. The option buyer is getting screwed 3 cents a day. And if I just sit here and do nothing, I get paid 3 cents a day times 100. So $3 a day. So this has got some good extrinsic value, which means I will do nothing with this. I will just sit around and wait for expiration. And who knows, the price could do anything by then. All right, so that is, let's see, I did Hut, Riot. Did I? Yeah, I did 5 contracts in Riot. I have 100 shares of Hut, but I'm doing nothing with that one. And, oh, that's right. I just sold a put on CLSK. And I still have not been assigned. I think this will be the second week. So collected $50 here, 15 times 5, 75 there, and did nothing here. So was that about 120 bucks? So what I generally do is I will either buy shares, or in this case, I use MicroStrategy as my store of value. So I'm going to go ahead and buy fractional shares. So that 120 bucks premium that I just made, I'm going to buy, however, I'm going to buy 0.087 shares, which of course will benefit to the stock split as well. So when this splits 10 to 1, I'll end up having 10 shares, which changes the value not at all. But I don't know. I guess it does allow more people into the space because they just don't think it's worth buying fractional shares, but it really just doesn't matter. So when MicroStrategy pumps to $2,000 or 2,500 the next time, I will sell off some, and then my assumption will be that one of these mining stocks will have appreciated less from that Bitcoin pump than MicroStrategy has. And so I will be able to sell MicroStrategy high and purchase shares of a mining stock low. And then I'll be able to sell even more covered calls. So maybe I'll have 600 shares of Riot, 700 shares of Riot when that happens. Or I can sell 2 puts in CLSK. Or I could add, no, I already have Riot, Hut, and CLSK. Those are the 3 miners that I sell because they all trade in increments of pennies now. So I hate when I go to a stock option and the bid-ask spread is a nickel apart. That really pisses me off because I'm losing, as much as $5 per contract every time I enter and exit that trade. And that makes me unhappy, especially in a small account. You always want to find penny increment options contracts if you can. You will lose a lot less money getting in and out of trades. This is new as well. I couldn't wrap I studied this MSTY. They're already doing the covered call strategy themselves. And they do use a synthetic version. They're like selling puts, and I think they bought some long calls, and they got U.S. Treasuries on the books that they use to pay for everything. And it's a synthetic covered call strategy. But they basically return the profits in some kind of yield. It's a dividend-like yield. And I just bought one share because I want to see how much they pay me. And so I'll report back on this as well. But that's just for fun, really. I figured I would just buy one share and see what the actual returns look like. All right, that is it. That's all it takes to earn 1% a week. I assume that took less than an hour. So once I quit my 9 to 5 job, I should be able to just work an hour a week and basically earn more than working 40 hours a week. So looking to exit, the rat race at least by the end of 2025. I've been work optional for a couple of months, but I guess I'm trying to just milk the salary for another year and a half or so. Um, unless I just, if MicroStrategy goes to 3K, I might not be able to bring myself to keep clocking in. But so we'll see. Congrats to everyone who is holding MicroStrategy and is going to benefit from the next pump. Not financial advice, but if this goes where a lot of us irresponsibly long folks think it will go, it's going to be a fun ride over the next 16 months. So, welcome to all the new followers, and big shout out to Jeff for name dropping me, and 50% increase of my follower account overnight. It was up like 25% when I went to sleep, and I woke up this morning and it was up another 25%. I was about shit myself. But shout out to everybody. Ask questions. I love questions. I love answering the questions, and a lot of times it'll just give inspiration for another video. And so, all right, be good, y'all.